right, hey, welcome everybody to Money Club Mondays. It's June 26th. Summer is in full swing. We had the longest day of the year just a few days ago, and I can't believe this year is flying by, halfway over. So I hope everybody's having a great start to the week today. It was my dad's 70th birthday on Friday, so we had some family in town and had some celebrations with him over the weekend. Went down to a Miami Marlins game and had a good time yesterday doing some barbecuing and hanging out around town. So with that being said, welcome to Money Club Monday. So this is a weekly show that we do every Monday. Now, I will say that we have a pretty good mix on here of people on right now that are brand new to Money Club, Private Money Club. Maybe they aren't members yet. They're just checking this out for the first time. And we have a lot of people on right now that are experienced, that are members of Private Money Club and that have done deals on there. And so I'd like to try and provide a nice mix on these Mondays of kind of trainings and opportunities and try and make it a little bit for everybody. So if you're brand new, you have a good feel of what this is all about. And if you have been around the campfire for a while, you still learn something every single week that you log on to these Monday shows. So with that being said, if you just put in the chat box, put if you're new or if you've been around the campfire for a while, just write that in the chat box, just so we can introduce each other to everyone else that's in here. Remember, a big part of Private Money Club is the community and the networking. So who's who? Let's make those connections. And primarily on Private Money Club, it's a platform for real estate entrepreneurs and those that have money that are looking for potential deals to lend on. It's a place for borrowers and lenders to meet and make those deals happen. So make note in the chat box, who is who's new on here. Make sure let's welcome everybody to the community. For those of you first timers, so Alejandro, great to have you here. Larry Dean, Ralph, John, Amanda, all new. So that's awesome. So great to have you here. What I wanted to do today is I wanted to talk a little bit about the different types of deals that you can lend on, or if you're in real estate on the active side, what are different types of deals that you can bring to Private Money Club that lenders are looking for. So you can get money, private money for those deals, and either do your first deal, do more deals, scale your business, maybe get into larger deals, maybe even playing in the smaller single family space and you're looking to get into mobile home parks or apartment complexes or multifamily properties. So what does that look like and how are some different ways to make that happen? So we're going to go ahead and talk a little bit about that. So Trent said he's new to everything. Met Chris over the weekend and started diving in. Well, welcome, Trent. Yeah, Chris was sending me text messages over the weekend and said it was an awesome group you guys had there. You're up in Montana, I believe, right? So they were up in a mastermind in Montana, and Chris said it was amazing, some of the people that were there and the connections being made. And at the end of the day, that's what Private Money Club is all about, is making those connections. And the more events you can get to, the more webinars you can get on, the more success you're going to have in business. So Jeff said, first time new here, recently created an equity fund for family-friendly feature films with years of experience. Very cool, Jeff. Very cool. So right now, Private Money Club is more focused around real estate. But if you go to the forum, so let me just share my screen and we'll talk a little bit about Private Money Club here for just a second before I get into some different training here. So if you can see my screen right here, this is Private Money Club, just privatemoneyclub.com before you log in, some of the different testimonials you can check out. And remember, if you're new to Private Money Club and you want to learn more about it, you can click right here where it says see how it works and schedule a time with my demo team. And my Money Mentor demo team, they can walk you through the site. They can explain to you some of the different coaching we have available if you're like brand new and really want some help and some hand holding. Premier membership includes a 2-hour coaching every single month. We do these Money Club Mondays every single week. And there's a ton of education in the Learn section on Private Money Club. I'll show you in just a second. But if you want to learn more, you can hop on and say, okay, tomorrow at 3 o'clock, I'm going to hop on a demo and have the team kind of show me, what all is going on with Private Money Club. So, that's one way to do that. But while we're on right now, let me just kind of give you some highlights. So now we're over 5,000 members. Actually, these numbers need to be updated. So we're over 5,000 members now, hundreds of deals, and over $100 million in transactions. Some of the different testimonials. All right, so let's go ahead and log in and I'll show you what this is all about. All right, so when you first log into Private Money Club, now I am a premier member. So there's two different membership options. There's a free membership, which allows you to go in and access this forum that you're looking at right now. You can access the blogs. You can access some of the Learn section. But what you do not get access to is the deal section, the full Learn section, the 2-hour coaching every month, all the resources like example promissory notes and deed of trusts, the perfect loan proposal, the house folios, analyzation tool. So that's all exclusive for Premier members. So to be a Premier member, just on privatemoneyclub.com, you can join. It's an annual membership. It's $1,497 a year. But we typically have a discount that brings it down to $997 available. So if you want that discount, just schedule a call on that demo on privatemoneyclub.com, schedule a demo, and my demo team has the current discount code for this week that they can give you to discount that annual membership if you want to get access to everything. All right. So just kind of walk through this public forum. Like I said, even as a free member, you have access to this. So you can see Michelle and Vin have been on here really trying to strike up some conversations. And then every time somebody responds, it bumps this right back up to the top. So you can see they've been having a lot of responses to what's going on. So like, why aren't we working together? I'll just click on right here. It's just kind of creating relationships again. So they go on, they start, chatting with different people, what they're doing. Nick is a Premier member that's been on for a while. Eric comes on a lot of the trainings. So you can see some of these different conversations and you can hop into them. So you can start, responding. You can write your own comment. You could create your own post on the public forum, or you can just browse through and start getting a feel for everything. And this forum is going to be relevant in a second when I start talking about the different types of deals that you can do on Private Money Club. So just keep that in mind, that some deals you're going to put in the deal section, other deals you're going to put in the public forum. And we'll talk about that here in just a second. All right. Just wanted to point out some of this stuff that's on here. All right. You can just scroll through and kind of look at some of these different posts. All right. And then, so that's the forum. And then of course you have the deal section. This is exclusive to Premier members, but the deal section is what allows you to go in and actually post deals that are available. So if I'm a real estate investor and I'm doing a flip, well, I might want to raise money for the purchase of the home and the rehab of that home. And I might be looking for money to do that. So I can post my deal on Private Money Club. Then lenders that have money that are looking to lend can go on and they can start looking through these various deals that are available for me to lend on. So you'll see first position liens on here. You'll see second position liens on here. This is all stuff I'm going to talk about in just a second. So I'm just going to point some of it out. So let's just take a look at a couple of them real fast. So again, the deal section are for individual properties that you're looking to create either a mortgage or a deed of trust on. So it's a direct lending where I'm lending to Carson's company. Remember, you only lend to a corporation or a company. You never lend to an individual. You're always going to use all the financial documents like a bank uses. Again, this is all in the Learn section, and we train this on extensive trainings, which kind of hitting the basics. So you're always going to use, for example, a deed of trust or a mortgage document, a promissory note. It's going to be drawn up by an attorney, for the specific deal. As a lender, you're only going to lend to a company or corporation because of different laws out there. But everything's going to be, paperwork's going to be done. You're only going to send money to an escrow company or an attorney. You don't want to send money direct to somebody or a company. That way the escrow company can make sure that the closing happens and then distribute the money appropriately. And you also want to make sure that attorney or escrow company then takes that closed deal and paperwork and records your mortgage or deed of trust at the courthouse to make it all legal. And of course, you want to make sure you're on there as additional insured. So if something happens, you get paid out from the insurance company and all the little details that we talk about. So here's an example of one right here. So this is a 16%. It looks like he's offering 16% and he's looking for $40,000. So then I can go on here and I can read a little bit about what the deal is, what they're doing with it. I can learn more about it. Now, Carson does not have any documents on here. Oftentimes you'll see documents. So you'll see a perfect loan proposal. You might see more of a full deal spec sheet, listing out all of the work that's being done so you can learn more. You might have, other documents on here, whatever might support more pictures, something like that. So if I wanted to reach out to Carson on this deal, I would click right here, I'm interested. And then I could say, hey, I want to see your perfect loan proposal, or hey, let's connect on a call to discuss further, whatever it is. And then I said send message. And then once we make that connection via the messaging platform on Private Money Club, if you do decide to do the deal together, you're going to click on deal in progress, and then it's going to bring up a checklist for you. So then you can make sure you're getting everything done that should be done on a private money deal, like filling out the mortgage, sending the money to the escrow company, doing your due diligence, everything that happens. So you'll receive that checklist all the way down to, the interest payments coming in, and then, you getting your money back at the end of the deal. And then once that happens, then you guys can review each other, and that way we can share with the community how that transaction went. So then Carson, when he does another deal, if everything went smooth, then we will know that Carson, had a good transaction there, so we can learn from each other. All right, so that would be a deal that Carson had. This is a HELOC microloan backed by cash. So you have some different second lien position loans. The second lien position, we'll talk about that in a second more. One of the things that's nice about a second lien opportunity, like you see on some of these right here, are the dollar amounts. So they're only looking for 30,000. They're looking for 35,000. A lot of people think in private money lending, you have to have hundreds of thousands of dollars to get involved in these deals. Well, you can see right here, there's plenty of deals in the $30,000 range that might make sense for you. Maybe they don't make sense for you, but for some people, they do make sense. So here's a first lien position, $75,000. First lien position, $200,000. First lien, $128,000. So you see there's some lower amounts on here, which is great to see. Because for a while, we're seeing $300,000, $400,000, $500,000 deals only on here. So some of these smaller ones are kind of good. So you can scroll down through here, and here's one for $450,000. So you can scroll down through, you can find these deals. Maybe it makes sense. Maybe you just build that connection for the next one. With that said, any questions on any of that, kind of what that looks like? And by the way, if anybody does have any questions as we're going right now, please feel free to write those in the Q&A box, and we will definitely cover. I'll answer any questions that you guys have on. So I'm going to bring my whiteboard over for today's training, because I want to talk a little bit about different types of deals that we have. So maybe one of these days I'll get one of those cool monitors and hang it back here. But for right now, I go old school. I got the whiteboard. I personally actually really like the whiteboard. So hopefully everybody's all right with that. All right, so let's talk about different types of deals. And I want to go over this today because I've been getting this question a lot. What type of deal on Private Money Club is right for me? Or where, I have this type of deal, like how do I use Private Money Club for that? And things of that nature. So let's go through not only the types of real estate deals. So especially if you're a lender right now, this is going to be very valuable, because you want to be able to really look at the pros and cons of different types of deals. And depending on where the money's coming from, and even the length of it, is going to play into this. So let's kind of go through this. All right. So we're going to talk about the types of deals, and then to kind of make it relevant where the money's coming from, let's also talk a little bit about the sources of lending money. Okay. And then what we can do is we can kind of pair these up, like which one is right for what. All right. So let's start with different sources of money, like where those of you that are lending on Private Money Club, or if you're here for the first time, where are you? And Selena, you don't have to put your phone number in here. If you just go to privatemoneyclub.com and create a free profile, go introduce yourself on the forum and start building connections that way. It's a lot easier a lot of times than a chat box. I don't mind you doing it on here, but just thought I'd, recommend that also. All right. So those of you that are lending money, where are you lending money from? Like, is it cash? Like, where's the money coming from? I'm going to write down the 4 most common places I see that people are lending money from. So we'll just start with cash. So cash would just be in a business account, a checking account, savings account, just regular cash, no advantages. And a lot of people lend from their money multiplier, infinite banking policies. And if you're new to this, when you start, kind of digging in and diving into more of what we do, what Chris and I do is we teach how to take back control of your money and solve your money problems. So we do this through different strategies. One of the strategies that's a main foundation for everything we do is called the infinite banking concept, and the brand is the money multiplier. So that's where we take a whole life insurance policy and we dice it up and we hack it up and we turn it into what we call a banking policy or new banking system. And by doing this the right way, we're able to put money into this thing, and every dollar we put in there compounds, tax-free, guaranteed for the rest of our lives. Every single year it compounds and grows for the rest of my life. And then simultaneously, I'm able to pull the money out of there and use it for things like private money lending and real estate investing. So that's what I'm talking about with the TMM, just so you guys know. And we have tons of trainings on that that we talk about, but just wanted to throw that out there if you're new. Okay. So qualified funds. So this would be like an IRA or a solo K or even a 401k. So the way we do this is if you have an old 401k or if you have an IRA, whether it's a traditional or a Roth, or you have like a SEP or a simple, if it's at a financial advisor, like a Fidelity or at your bank or something, you're going to want to move that over and turn it into what's called a self-directed IRA. So that's where SD comes into play, self-directed IRA, because then that allows you, because an IRA is great. If it's at Fidelity, though, you're locked into only investing in what Fidelity allows you to invest in, which is the stock market or index funds or various mutual funds or whatever the case is. By moving it to a self-directed IRA, now you can control that money and they'll allow you to invest those qualified funds into things, like private money deals and real estate deals. So that's the only difference. Now, you can have a self-directed solo K or self-directed 401k, but those of you that are in an active job and have a 401k, you typically can't move that to a self-directed custodian. It's locked up there while you still are actively at that job, but you can borrow against it. Typically, you can borrow up to $50,000 from your 401k. So then that then gives you access to that money that's locked up in that 401k. And then you could take that 50K and maybe lend it on some of those deals I just showed you, in that $35,000 to $50,000 range. So now you get the money out of the stock market and then into an investment that you can control and decide on the growth of it and what that's going to look like. So that's a great source of money because if we're using qualified funds, this is all tax-free growth or tax-deferred growth within the self-directed IRA, depending if it's a traditional or a Roth. So great move. And then the fourth, I guess, would be like leverage. So something like a HELOC or a HELA, a home equity loan agreement or a home equity line of credit. So this would be if you own a home or own property and that property is appreciated, let's say you owe $200,000 on it and it's worth 500 grand. Well, you have $300,000 in equity in that property. And instead of just letting that money, not do anything because it's just equity, it's not real yet. It's just kind of in the rafters, as they say. What you can do is you can tap into that equity through a HELOC or a HELA. And now we have access typically up to 80% of the equity. So 80% of 300 grand is whatever that is, $240,000. So now we have $240,000 that we can use to do some of this stuff with. And I'll talk about the pros and cons of this in just a minute. All right, so those are just some different places where money might be coming from. And I want you to think to yourselves, do I have money in any of these places that I can put to work for me in these different types of real estate deals that we're going to talk about right now, okay? All right, so let's talk about these different types of deals. All right, so let's start with direct lending. And I see Noah Harris is commenting in right now. So Noah is one of our coaches in Private Money Club. He and his wife are experienced real estate investors for the last, 10 to 15 years now. That's their primary business, but they also do coaching on the side and they run a mastermind that they put on live events a couple times a year called Re-Up. And so it's great to see Noah here. Looks like he's in the chat box. So if anybody has any questions, Noah runs what's called our accelerator coaching program that teaches you, if you're new to this, how to ask for the money, or if you're on the lending side, how to smartly create those relationships so you can lend your money out and do it time and time again. So what to look for in deals, how to do it the right way, how to protect yourself, how to communicate that. So that's exactly what Noah teaches to our accelerator coaching groups. Just to give a shout out to Noah since he's on right now. And this is what Noah does a lot of. Noah does a lot of direct borrowing, okay? So Noah uses a lot of private money through Private Money Club to do the deals that he and his wife do. They do a lot of little flips. They're in the Columbia, South Carolina market. So it's a lot, it's nothing expensive. Usually what I see Noah is like in the couple $100,000 range. So it's a great thing that they do. So great borrower too, if there's any lenders on here that are looking to build relationships. All right, so direct lending would be, if you have a single family home and you're looking to buy it, rehab it, and flip it, or buy it, rehab it, and maybe refinance it down the road, what's called the BRRRR method. So here we go. So that's direct lending. So it's just basically, this is where we would use two primary documents, a mortgage or a deed of trust, and a promissory note that lays out the terms of the deal. That's connected to this. Now, again, the way that this direct lending deal works, the pros to this, list out some pros. It's negotiable. So the terms are negotiable, meaning interest, amount, length, etc. So everything's negotiable in one of these deals. And there's lots and lots of these deals available in Private Money Club. There's a lot of investors that are looking for money so they can do more deals. And so you have a lot of these available to you. You can browse tons of them all day long until you find the right deal. And then once you start lending to somebody, typically that borrower will always have another deal available to you ready to go. Okay. So you can keep your money moving pretty quickly, because as soon as one of these deals the money gets returned to you, you can lend the money again and just keep it going over and over again. Okay. So some different things with those, the amounts can range huge different amounts. So typically, 50K to millions of dollars, depending on the deal. So you have a large range that you can lend on. What else? Those of you that are doing lending and borrowing, doing direct lending and borrowing, what are some other things that so what are the pros to this? Well, again, it's negotiable, but if you want like monthly interest, for example, so here's some stuff to consider. So at the bottom here, I'm going to write considerations. So if you're a lender and you're lending money from one of these sources, what do you need to look for to make these different types of deals make sense for you? Okay, so follow me. So number one, how is interest paid? On most direct lending deals, when I lend my money to Noah on a house, what's going to happen is, let's say I lend $100,000, and let's say it's at 12%, $100,000 at 12% in a first lien position. We'll talk about first, second position in just a second. Let's say I'm lending my money in a first position, $100,000 at 12%. Most agreements are going to be made for 12 months, for 1 year. Although typically it's going to be like, we expect to pay you back in 6 months or whatever. There's no prepayment penalty, or maybe there is. Again, it's all negotiable through the terms that go in this promissory note that's connected to this mortgage that's recorded at the courthouse, that gives you the rights as a lender that if Noah does not pay me as agreed upon, I have the right to foreclose and take that property. I have the right to have Noah turn over that property to me without having to go through formal proceedings, because it's built into the mortgage that way. I can go after Noah personally if there's a personal guarantee built into this. So there's a lot of ways that our money's protected by using these legal documents. But we're talking about considerations right now. So how is interest paid? And why this is important is because when I'm negotiating the terms of this thing, we want to lay out exactly how that's going to happen. So how most deals are going to occur, typically what you see is monthly interest payments. Okay, so if I lend $100,000 at 12%, that's $12,000 for the year that's paid in interest, or $1,000 a month. Okay, if you take 12,000 divided by 12 months, that's $1,000 a month. So the way I would structure this deal, if I wanted monthly interest payments, is that's how I would do it. I lend you the money. I start receiving, monthly interest payments based on the interest rate of 12%. And then at the end of the term, or as soon as he is ready, he pays me back the $100,000. So I give Noah $100,000. He pays me $1,000 a month until he gives me the $100,000 back. Basically what that deal would look like. Now, here's where this might change, and something to consider for your personal situation, depending on where the money's coming from. If I'm using cash to lend on this deal, I might need that money to live on. I might be lending money with the idea that the money that my money's making, I'm using to live life. So if I know, for example, let's say I want to buy a car, okay? And that car payment is $1,000 a month. Well, I know that if I take $100,000 that I have sitting in savings and I lend that to Noah on this deal right here, Noah's going to start paying me monthly interest payments that are going to make my car payment for me, just as an example, okay? So in that case, I would want the monthly interest payments coming to me because I'm using those to do something in my life. Now, maybe maybe that money's coming from an IRA and I'm only 40 years old, so I can't withdraw that money from the IRA anyways. So to me, I don't really care if my IRA is growing $1,000 a month or growing $12,000 a year. If that money comes in all at once at the end, or that money comes in every single month, I don't really care, because I'm not touching that money because it's growing tax-free in a Roth IRA until I'm, at retirement age, 59 and a half. So it doesn't matter. So when I'm negotiating this with Noah, I might say, hey, Noah, I'm going to save you some time and energy and cost, administrative cost, because I'm not going to require you to pay me every single month and track that and cut the check and all that stuff that goes into it. Like, I'm not worried about that. So instead of giving me 12%, why don't you give me 13%, but you can just pay me all the money at the end. Whatever interest accrues, just give it to me at the end. I don't care. So maybe to Noah, it's worth him paying an extra percentage point at the end to not have to do all that work during the process. Or not. Maybe it's not worth it to Noah, but that's a conversation we can have. So this is something that I want to consider, is how's the interest being paid? And where that really comes in important is something like a HELOC. Okay? So when you have a HELOC, it's a line of credit at a bank. The way a line of credit works is when the money's at the bank, you don't pay for it. And as soon as you take the money out of the bank, they require a monthly payment to pay that HELOC back. But the bank requires that, okay? So you have to make that monthly payment to the bank. So if I am using a HELOC to lend money on this deal, what I'm looking to do is I'm looking to make what's called a spread. So I'm looking to make a spread. So if I'm lending money at 12% and I'm paying 8% in my HELOC, I made a 4% spread. 4% is not a real great return, but remember, if this is done the right way, it's kind of like free money in a way. Because again, the equity in your home is just in the walls right now. Once you have access to a HELOC, now you can take that money and put that money to work and create additional income. So while 4% might not be a huge spread, let's look at that at scale. Let's say I have $300,000 in equity sitting in my home right now, which a lot of people have at least $300,000 in equity in their homes right now. So if I take, let me do the math right now, $300,000, and we times that at 12%, 12% loan, that's $36,000 a year. So that's $36K, but I'm paying 8% on that money. So let's see what that is. So 300 times 0.08, 8% is 24,000. So what did I just do right there? I created, after the spread, I created an additional $12,000 a year for myself, or $1,000 a month. So if I'm buying $1,000 vehicle, $1,000 a month vehicle payment, by tapping into my home equity that otherwise would have just been sitting in the rafters and lending it through a private money deal, negotiated the proper way and with the proper documents, I've now created my home paying for the vehicle that I drive every single day. Now, I'm not saying to go do this, just kind of throwing out ideas right now and things that other people are doing and things that you can think about, all right? But in this case right here, I would want that interest to be paid monthly though. Because why? Because I'm paying that HELOC back every month. So I want that spread to give me enough money to cover the HELOC repayment as well as whatever profit that I'm making, that I'm using to live on. And then once the HELOC gets replenished and we get the principal back, now we just take it and we do it again and again and again and again. Win-win. I love it, Noah, absolutely. So that's one consideration right there for a direct lending deal. The other consideration, right, you're thinking about this stuff is the length. So the length of the loan. When it comes to the length, it's not as important over here. You know, maybe in an IRA again, because you can't touch that money until later in life anyways. So if you get into like a long-term 5-year investment or something, like, it doesn't really matter because you're not getting that money back anyways. So it just kind of depends on where the money's coming from, you know, would factor into the length. But, you know, when you're looking at deals, you're going to see deals. Hey, I need to borrow the money for 3 months. Hey, we're expecting 6 months, but it could be up to a year. Or, hey, this is a longer term play. So we're looking for somebody to lend to us for the next 5 years because we're doing some creative financing or seller financing. And so we're going to need the money for a longer period of time. Or maybe we're expecting this project to take, 2 years, something like that. But it is something you want to think about because, you know, depending on what you're doing, but let's say that, hey, let's say next year I want to launch a business. Well, I don't want to lend on a deal that's going to be out there for 5 years if I need my money next year for something. But I also don't want my money to sit over the next year and lose to inflation. So I need to keep my money moving. So if I know my time frame, then I know when I'm looking for deals, if it's something that goes beyond when I need the money back, I can skip over that deal. Or if I know that, hey, this is going to fit within my time frame, when I'm negotiating with the person, I'm going to make sure, hey, I need this money back by then. So we need to structure this thing in a way where I'm going to get it back because I need that money for another venture or whatever the case might be. All right. So just some things to consider again when we're looking at different types of deals.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
Now, I mentioned before, first and second lien position. So when you're doing a direct lending deal, you're going to see, especially on Private Money Club in the deal section, you're going to see different first and second lien position deals. So let's talk about what those mean real fast. So in a direct lending deal, you're going to see this a lot, first and second lien position. So let's just talk through it because there's pros and cons to both, obviously, like everything else out there. I love that, Noah. Noah said, want to get great at borrowing money, find out your lender's goals, wants, and needs, and offer them what they want. There's no reason to shove a square peg into a round hole when you can adapt and you can make the hole square and let it, or round, and make the peg fit perfectly, right? So let's do that. I love it, Noah. Thank you. All right. So first and second lien position. What does that mean? When there's a lien that gets placed against the property, there's different levels on what that can look like. All right. So typically a mortgage would be used if this home right here, let's say Noah's buying this house. Okay. Noah's buying this house for $100,000. And Noah needs to borrow $100,000 to buy this house. Maybe the house is worth $150,000, right? But he's getting a good deal on it. So the house is worth $150,000. Noah needs to borrow $100,000 though to be able to buy that home. He's got a good deal going on it. It needs some work involved. So that's the deal that Noah got. So if Noah goes to a bank, and any of you that own a home, this is what you did. You found the home that you want to move into. You applied with a mortgage broker or with a banker, and they, approved you for a mortgage. And that bank or that mortgage company, the lending company, whoever it is, they placed a mortgage on your home. Exact same thing. We're going to do the exact same thing with private money lending. So if I decide I'm going to give Noah the $100,000 so Noah can buy that house, I'm going to do so with a mortgage and a promissory note. And that mortgage is going to be in a first position lien. And that mortgage is going to get recorded at the courthouse. And it's now going to be a legal document that if something does not oblige by the terms of these documents, that I have the right by law to foreclose and take over ownership of that property and kick Noah off of it, basically. Just like a bank would do if you don't make your mortgage payments at a bank. First lien position, it's the top dog. So if something happens and the stuff's getting paid, the first position is going to have the first right to go after that property to get their money back. Whether they auction it off, whether they sell it, whatever happens, they're going to get their money back before anybody else on it. The first lien's the top dog. So that's a pro, because everything we look at with this is going to be risk reward. Remember this. This actually should go under considerations. So the lien type is going to be a consideration because that's going to go right into your risk versus reward. If I give Noah $100,000 for this property, Noah might be willing to pay me 12%, and I'm in first position. So my risk is a little bit lower, assuming everything else is done right. I vetted Noah, I underwrote the house and made sure it truly is worth $150. Even in today's state, before repair and everything, I'm giving him $100, it's worth $150. That's a good what's called loan to value. Loan to value is what it sounds like, how much I'm lending versus what the property's worth. And so when I'm looking at risk reward, less risk because I'm in first position, less risk because I have a nice loan to value ratio on here. My reward, 12%. I think it's pretty good for that amount of risk. But here's how some things could change on this even in a first position. Let's say that the house is worth $150,000, but Noah wants $145,000. So basically Noah wants what the house is worth. Well, when I look at my risk versus reward, that increases my risk, because if something doesn't go right and I have to take that property back, well, after attorney's fees and time and everything, I might be upside down. I might not be able to get back all of my money that I gave Noah. So that's a lot more risk. So maybe I want to do that still. Maybe I don't. Maybe if I do that, I tell Noah, hey, because there's more risk in this, I want 18%, right? Or whatever. And then Noah can decide as the borrower, hey, it's still worth it for me to do this deal, or no, I'm not going to do that. I'm going to pass up on it and move on to the next one, right? Or whatever the case is. So risk versus reward. So that's one thing that could happen. When we look at risk reward, you're also going to see what's called a second position lien. All right. So on Private Money Club, you might see some deals on there that are second lien position. And what that means is that there's already a mortgage on the house. It could be, there's already a first lien position mortgage on the property. So it could be, me lending to Noah, and that's my mortgage. It could be a typical bank loan from, any of the big banks out there. It could be hard money from a hard money lender. Whatever it is, there's already an existing first lien position on that property. So what that means is when I'm looking at doing a second position lien, I need to think to myself, okay, how much am I lending? What's the property worth? How much is the first lien position loan? And is there still enough money in there if something goes bad where the first lien will get paid off and there's enough money for me in the second lien to still get my money back as well? I am no longer the driver in a second lien position. The first lien is the driver. So the foreclosure, they got the first rights, like they're in charge of this whole process if something goes wrong. I'm kind of sitting there getting scraps in the passenger seat, so to say. In this scenario right here in a second position, guess what happens? Your risk goes up. Anytime your risk goes up, what else should probably happen? Your reward should probably go up, or you skip it completely. But if you're willing to accept that level of risk, then maybe you're only willing to accept it if you get a higher reward. So instead of 12%, you say, well, I'm not the driver. Everything else still looks good. Like it's 100,000. They're only asking for 10,000 more. The house is worth 160. So there's still plenty of value in there, equity in there if something goes wrong. So I'm willing to do the deal. But because I'm a second position, I want 16%. I want a higher reward because of the higher risk that might be involved with it. Does that make sense to everybody? So those are some different considerations when we're looking at what type of loan is on there. There's nothing wrong with second position if done the right way in the right circumstances, okay? So things that I look for in a second position, so some different things you might want to think about. How much and who? How much and who is in first position? Okay, so that's one thing you want to think about. And that's where you want to ask the borrower, okay, I understand second position, who owns the first position loan? What does that structure, what does that deal look like? What does that first position look like? Is it short-term financing? Is it long-term financing? Is it a high interest rate? Is it a typical bank loan? Like, what does that look like? Because that could give you some insight into what they're doing with this, right? So just different things like that you might want to be thinking about. Why? Why do they want that second position loan? Is it for rehab on the house? Just some different ideas to kind of reduce risk. Can they cross-collateralize? I'm not going to get into all the details on that right now. We do that in more advanced trainings. But cross-collateralize basically means, hey, I'm lending you money on this property, but I want collateral on other real estate or other property that you own as well. So if something goes wrong, not only do I have this property as collateral, I have other properties as collateral also that I can go after if the case might be needed. Or maybe personal guarantee. Okay? Maybe a personal guarantee, meaning if something goes wrong, not only can I try and get my money back from the property, but I can actually go to your personal assets and go after you personally as well. Again, all we're doing over here is the risk reward. Increase risk, higher reward. How can we get the risk down and still get a reward that makes sense for us? So just some different ideas, possibly of things that maybe you can talk to the borrower about. How does this reduce my risk, but still get the deal done for you and make sense and create this win-win situation for everybody that's involved? Okay, so two other types of real estate, ways of lending on real estate that you might run across in the Private Money Club, in the forum. You might run across this stuff if you attend any kind of masterminds or live events. We have an event coming up in the first Friday, Saturday of August called the Money Tank. And the Money Tank is located in Raleigh, North Carolina area. Actually, I'm going to pull it up on the screen because you're going to see a lot of this stuff at Money Tank. I know a lot of the people that are coming and they have a lot of these different types of deals. And so I'm going to go through these with you, but I just want to talk about Money Tank real fast while I'm thinking about it. So this is Money Tank. And I'll put this in the chat box in just a second. But Money Tank is an event that we started this year. We had one in the spring out west in Utah, and now we're having this one at the end of summer and first weekend of August over on the East Coast in Raleigh, North Carolina. So this is a Friday, Saturday event. It's 2 full days. The speakers we have coming forward are really, really, really good. But more importantly is you're going to be around for 2-3 days with other people, other lenders, other borrowers, other investors, other business owners, and you're going to learn about a lot of opportunities there. And so, if you're looking for that kind of thing, you got to come to this event. And so you can go to privatemoneyclub.com/money tank and learn a little bit more about it. But, and I'll give you guys a discount if you want to buy a ticket. So I have a discount. It's PMC 300. That'll give you half price for a general admission ticket or $300 off for a VIP ticket. So I'd recommend the VIP. Just because we're doing something really fun Friday night for the VIP. We're bringing in somebody that's going to play some music and do some really cool art and stuff. And we're going to have a really good time with it. So go ahead and go over and get a ticket and try and do that if you can, like today or tomorrow. Go ahead and buy your ticket. And because we need it, we're starting to finalize some of the numbers and everything. So if you don't mind, go ahead and buy your ticket now. And you can always make your travel arrangements and stuff later on. But go ahead and buy a ticket while you can now, just so we can get those numbers. But it's gonna be a lot of fun. So we're kind of redoing this page right now, but just wanted to point that out. If you're looking for a live event to really network and grow with other people, this is going to be the spot to be. Yeah, Tess, Noah, they'll all be there. Shauna will be there. So I wanted to bring up these other two because I'm starting to see more and more of these come on to Private Money Club in the forum. And I'm getting a lot of phone calls, asking about different types of, these different types of deals and what that looks like. So let's talk about it. All right. So pros, cons. So number one, direct lending. That's what we just were talking about, the direct lending deals. Pros for those are each deal you can evaluate and decide if you want to lend on. So every time you want to lend money, you go and you find a deal to lend on. So, that's a pro, is you're not lending typically on like a bunch of properties or anything like that. It's just one specific deal you lend on and then you get your money back. Two, usually they're short term. So you can lend, get it back, lend, get it back, which kind of could be a con too, because, let's say, over 12 months, you do 2 deals and each deal lasted 5 months. And then it took you 1 month to find another deal. Well, in that case, over those 12 months, your money was sitting for 2 of those months because you lent your money. It was returned in 5 months. It took you a month to find the next one. You lent your money, you got it back. So your money sits for 2 months out of the 12 months. So if you make 12% return on these deals, because the money was sitting for 2 months, you're actually not making 12%. You're really making 10% for the year because you're getting your money back and it's sitting for a little bit. So sometimes the short-term loans can bite you in the ass, as they say, because of that situation right there. So you always want to be looking for your next deal whenever you're expecting the money come back to kind of eliminate this from happening. Does that make sense? So I'm just throwing out some different things though right now. So pros and cons. So short term could be good because, again, you have control of your money. So you get it back. Maybe you have opportunities next year you're getting ready to, you need the money for. Well, you can get that money moving now and making money for you. And it'll be ready for you when you need. So just some different things like that. With direct lending, you're going to build relationships. So like when you find a good borrower or somebody you're lending to, like build that, because that way it's going to allow you to make this happen faster. But it is going to be a little bit more work involved because each new deal you are going to have to evaluate it. You're going to have to make sure the paperwork's done. You're going to have to wire the money. You're going to have to follow up and make sure it was returned. You're going to, if you're getting monthly payments, you're going to want to make sure you're getting your payments. If something goes wrong, you're the one that's going to have to get with an attorney and file foreclosure, or get with an attorney and request the money from, if you have like a personal guarantee, or, go after the person. So, you're the one, you're in complete control, but that includes not only on the profit side, but also on actually making those deals happen. So it's a little bit more involved. Once you lend the money, you're kind of sitting back and relaxing, but to lend that money in the first place, there is some work involved. So whether that's good or bad for you, you decide. But that's just some of the things that are going to be happening. You're in charge of every aspect of it. You're going to hear about private funds and you're hearing about syndications. So let me talk about syndications first. So a syndication is typically going to be for a specific property. Not always, but usually it's going to be for a specific property. And a syndication is usually going to be for like a big apartment complex. You see like a lot of apartment complex, multifamily syndications right now. And so what that means is in a syndication, you have what are called the general partners and you have what are called the limited partners. So typically the general partners are the ones that are managing the syndication. So they're the ones that are finding the deal. They're the ones that are doing the work on the deal. They're the ones that are paying the limited partners money. They're the ones that are keeping everybody in the loop. The general partners are running the business, so to say. Think of a syndication like a business. The general partners are running that business, every single aspect of it. General partners will usually have their own money in the deal as well. They usually have their own money in the deal as well. But then what they do is they look for investors known as limited partners. So limited partners, all they do is they take their money and they lend it to the syndication. And usually a syndication is going to be a longer term, so maybe 3 to 5 years, typically speaking. Sometimes you can see shorter ones, longer ones. How you get paid out on the syndication, it varies depending on the syndication and how they have it set up. So you might get interest payments, you might get the profit split on the back end once it refinances or it sells. So make sure you pay close attention to the terms and what that looks like and when you're going to get your money back. I will say a pro of a syndication is you can usually get some tax benefits in a syndication as a limited partner. So you lend your money to a syndication. Not only are you playing, getting money, depending on how it's set up again, but you're playing in the profits of it, but you also typically will be able to tap into the depreciation of that property. So when you're talking to the syndication, the general partners, find out what that looks like. What are your tax benefits? And is there depreciation that you get to play with as well on the lending side to maybe help with some taxes that you might be facing? So that could be a benefit. I know people that actually invest in syndications. I don't want to say they don't care about the profit, but they care more about the tax benefits and the depreciation that syndication is providing them than they do about the profits. Okay. So that could be a huge pro when it comes to a syndication. In my opinion, some of the most negative parts of syndications are the general partners. There are a lot of syndications out there where these people start these things, and to put it bluntly, they probably should not have. They should probably not be running a syndication. They probably should not be running a real estate business. They don't have the experience, or they're just not good operators. They're not good managers. And what happens with a lot of syndications is people get upside down. I've seen this happen a lot where all of a sudden they thought they needed $3 million to do this multifamily deal, and they fall $1 million behind. And then what happens is they have to go ask the limited partners for more money. Hey, the only way we're not going to lose money on this deal is to put more money into it. So we need more money from you. So I've seen them have to go back and raise more money, and it gets people upside down. It's not a good feeling when that happens. So I've just seen a lot of syndications go bad. So just from a personal experience, I'm not a huge fan of syndications. But with that being said, there are some good syndication operators out there. But I'm just saying, risk and reward, just know what you're getting into. I'll see if I can get a syndication operator or two, a couple of general partners to come on Money Club Mondays in the next couple of weeks, just so you can kind of learn a little bit more about what syndications actually do. So let me work on that, and I'll get a couple syndicators to come on and talk about syndications. Fair enough? All right, so those are just some of the things that I would point out when it comes to syndications. Now, I know we're up on the hour right now, so let me just hit private funds real quick, and then we'll spend more time in the coming weeks also, not only on syndications, but on private funds. I'm going to talk, in full transparency, just to make this quick. Let me tell you about a private fund that I'm a partner in, okay? Just so I can tell you exactly how this private fund works, and this is how a lot of private funds work in the real estate world. So this will be a good example, all right? So I'm a partner, as well as Chris Noggle, Greg Hurling, Kent Clothier, Justin Colby, just to name a few. We have about 8 to 10 partners in this private fund. It's known as Inicio Capital Group, Inicio Capital Private Fund. Okay, so this is a real estate-based fund, meaning all the money that we raise in Inicio is being lent out on these types of deals, on large scale deals, on land development, on rehab projects, on development projects, on projects that the partners of Inicio find through our years and years and years of experience. We did the math on it, and the partners in Inicio have well over 100 years of real estate investing experience. The majority of partners in Inicio went through 2008 and learn from that market, which I think we're going to be seeing coming up again. So how do we take advantage of that? And we did the math on it, and the partners in Inicio have done well over $1 trillion in real estate transactions. So The partners in Inicio are very, very, very experienced and very, very experienced in operating in the current market we're in right now and know how to take advantage of what's coming. So that's why we created Inicio. When you lend on Inicio, you're going to receive debt annually, paid quarterly. So you're going to have debt on your money. So if you lend us $100,000, you're going to receive preferred interest payments every quarter. And you're also going to play on the equity side. So all of these deals that we're doing within using the money from Inicio, which just so you know, it's a $12 million raise. So we'll raise up to $12 million for Inicio. We're going to keep the money for 4 to 5 years. And over the next 4 to 5 years, we're going to go into deals. So right now we're invested in 4 different deals. We're about to invest in a couple more deals. These are all time-sensitive, high-profit deals that we're investing in using Inicio funds, using your lender's funds, okay? So you're going to receive debt. You're also going to receive equity. So money that we make, profits that we make, you receive profit from the deals also. Now our total payout, we're looking for high teens. So let's say 16 to 19% annual. So each year, while this is not guaranteed, each year our goal is to return you, the investor, upwards of 20% on your money, okay? So you invest 100 grand, upwards of 17, 18, 19, 20 plus $1,000 a year in interest payments you can expect to be having come back to you for the next 4 to 5 years while we're doing these deals, okay? So that's just what a private fund is. So basically, when you invest in a private fund, you're looking at who are the partners in that fund, and do I trust them with my money to go out there and make smart real estate decisions to grow my money for me. So when you look at the partners in the fund, one of the first things you want to do is research who are they, what's their experience, and do I want to trust them with my money to go out there and do that? Plain and simple. And then you sit back and you relax. Why I like private funds is we have the money and we can invest in whatever we want. So like a syndication is built on one 50-unit apartment complex. And that's what the money goes to. That's all what's involved. If you need more money, you got to put more money. With a private fund, we're flexible, we're nimble. We can take that money. We can do 3-month loans. We can do 6-month loans. We can do it on a single family home. We can do it on a 50-unit apartment complex. We can do it in a 4 Seasons private residence development, which is one of the things Inicio recently invested into. So we can move that money depending on what's going on with the market and be smart to get these high returns. And you don't have to worry about any of that. We're never going to say, hey, you need to give us more money for the private fund. A, we can't do that. It's illegal to do that. And B, we never would because we know how much money we have. So we know how much money we're investing into these various projects that we're moving the money through. So for the next 4 to 5 years, you would put your money in Inicio, for example. You would receive quarterly debt payments. You would receive annual equity payments, and you don't have to do anything. You just sit back and relax. We send out a newsletter every single month that basically that tells you an update every month on what we're investing in, how much money was raised, how much money was deployed that month, all that stuff. So you're kept up to date, but you don't have to worry about any of it. All right. So that's just one example of a private fund. And there's different ways to set up private funds, and there's different, reasons why they are. But this is just what I've been super excited about. We've been raising money now for a few months. It closes at the end of July. And so if anybody's looking for something like this, shoot me an email and I could send you more details and we can hop on the phone and talk a little bit more about it. So just some of the differences in private lending versus private funds versus syndications. All right. So I hope that helped everybody today that was on. Like I said, if you want to learn more about Private Money Club, the premier membership, or any of the coaching that we offer, such as Noah's Accelerator Coaching Program, go over to privatemoneyclub.com and schedule that demo call. If you want to come to Money Tank, go over to privatemoneyclub.com/Money Tank and use PMC 300 for a discount on that. And if anybody wants to learn more about Inicio Capital Group or just has any questions for me whatsoever, do not hesitate to reach out. That's why I'm here. snagy@privatemoneyclub.com. That's my email address. I'll put it in the chat box. snagy, S as in Stephen, N as in Nancy, AGY @privatemoneyclub.com. If you guys need anything at all, have any questions about Private Money Club, private funds, anything I talked about today, please don't hesitate to reach out. I'm here to help you. All of the existing members, thanks for being here. Everybody that's new, if you haven't already, create your free membership. Go post on the public forum, say hi, introduce yourself, and we'll get you guys rock and rolling, either borrowing or lending money. Hope everyone has a great week. We'll see you guys later this week for the rest of our webinars. And we'll see you next week for Money Club Mondays, every Monday, 1 o'clock Eastern. Thanks for being here. Bye.